Good morning and welcome to Capital Academy. Capital Academy is a program designed to help early stage and startup companies know what's going on in the private equity space as they're reaching to find investors to help fund their projects and their ventures. There's information out there that sometimes doesn't get to those individuals. But this is also designed to help those who are interested in investing, especially early stage investors, to get some sense of what's going on in that exact same space. And today we have the pleasure of speaking with an angel investor about what goes on in that space as companies are being reviewed for potential investments. So Hilton, Augustine, thank you so much for joining us on Capital Academy today.
Thank you. I appreciate you having me on.
Absolutely. And I think what we're going to talk about will absolutely resonate to a lot of the early stage and startup companies watching, because they need to understand what investors are thinking about as they're reviewing.
Right.
So I'd want to step back for a minute and ask you, please give us a sense of who you are, what you do, and then we'll talk further about how you do it.
Okay, well good. Just to eliminate some of the mystique about the angel role, 80% of my time is spent really just screening companies. Initial screening, that could be a one-paragraph summary, it could be a one-page summary, it could be a pitch deck, from a variety of sources. I've primarily been doing this for about 5 years now, and as most angels are, usually some entrepreneur who's had some exit from some other business and things like that, and looking for other opportunities to invest that money and or participate at some other level in the company.
Right.
I personally got out of the operating role in my company, so now I look at very much in the role, in the capacity of advising, giving a lot of companies the benefit of my prior experience. And that role gets me involved in lots of companies in different areas. So that's primarily what I focus on, just about 80% of the time, screening and screening and screening. So literally thousands of companies in a month.
That's interesting, that many.
Yes.
That many. So as you're screening, especially if you're just looking at a one-pager, what in the one-pager gives you enough interest to want to know more about a company?
Well, everyone should understand that the first and foremost important thing that an investor wants to see is how they're going to make money. There are a lot of other bents on how people look at investments. There are social directions and things like that. But primarily, everybody's looking for an investment and a return on investment. So to the extent that you can show me in that summary that I've identified a problem, I know I can solve it, and in doing so, I can make you money, then I continue with the next level of due diligence.
Gotcha.
So that's the primary part. But again, if you went into a room with 30 other investors and we're all looking at the same pitch, the same summary, it's going to be across the board as far as who likes what and who takes what risks and things like that. So it's very extremely chemistry oriented as well. So there's a lot of things like that go into it. But primarily at the end of the day, we're all looking for a return on that investment.
Right. But I'm glad you said that, because, you know, and I'm asked the question often, and my answer is investors come in all shapes and sizes.
Exactly.
There is no one, well, how do investors look at this? It depends on, I believe, number one, where your interest lies, for which companies you're even going to begin to consider.
Right.
And then, so I'm going to go back to, and then once you start looking at that, so when you say, show me how I'm going to make money, my side of the fence is trying to help entrepreneurs put their package their information to stand out to investors as they send it to them.
Right.
But on a one-pager, in that one summary box that has financials, what jumps out at you? Because we know projections are just that, right?
Exactly. They're all hockey sticks.
Exactly.
Once I get your money, we're going to do this.
Exactly. You know, we're going from 0 to 5 million in 12 months, right? But what resonates to you when you see something like that to say, yes, let me get and I'm assuming the next level is the actual business plan.
Right.
But that's an assumption on my part.
That's correct.
So what makes you, from that one box 3-year summary of projections, what resonates for you to then want to read through a business plan?
Okay. For me personally, it's if you can succinctly explain the problem you're solving. A lot of people spend a lot of time talking about how big the industry is. It's always a $60 trillion industry, and I'm going to get 1% of that, and it looks good. But if you can skip over the fluff and really focus on, here's the problem I'm solving, and make me relate to the problem, then you got my attention, because I've had the problem, or I know people have had the problem. There's another case as well. Uber, nobody really understood that as a problem. So it's a problem we didn't know we had. So if you have a new concept in a new market, again, you got to be able to project that to me to say, yeah, it's not a problem now, but trust me, once we introduce this to people, everybody will love it. So if I can succinctly get that in that first paragraph, and how I can, and that's one sentence really, one or two sentences at the most. And then the next sentence really will be on, convince me that we have the capability to make that happen.
So is that the team? When you say convince me?
Not necessarily the team, but the whole process that says, for instance, if it's a product that you're manufacturing, sometimes you can tell me about something I can buy into the dream, but it's not manufacturable, or it's not scalable, or there's some other reason why this is not going to work. So then convince me that it can be done, and then now you got my attention to go forward, because the rest of the logistics and the details of how you get there, but I got a big problem to solve, and I can solve it. And in the meantime, all I need is a little help to get there, which is your money.
One of the other big discussions that I have is investors understand that the business plan they're looking at today, the business is probably not going to look anything like that 3 years from now. Can you speak to that?
Probably not in 3 months. I've been through several business plans, and I go back to my first one that I wrote probably back in the early 90s, and look at exactly how much things changed right away. So the business plan really is a look forward at this point. And if someone can't change it along the way, it shows they're not adapting, they're not, and I'll tell you, some of the companies I've invested in, literally months after I invested, the company was already pivoting. And it was a good thing, because they realized it wasn't happening the way they planned. So I tell people, the business plan is a living plan. And you started here based on all the information you know, but as you get new information, the business plan has to change accordingly. And one was as extreme as we were consumer faced before, and realized the cost of acquiring customers were much higher than we thought, and a lot of the things that went into effect that we had to change and focus on the enterprise. And that worked well for the company, so they did well afterwards. But it was pivot, change, go back to your investors, let them know that the way we initially said we're going to invest your money is not happening anymore. But here's the new plan. We'd like your concurrence with that. And again, in another session, you mentioned how important it is to keep those investors happy, because you're going to be coming back for more money, another round of money, and things like that. So I want to know that, yes, just like with my company, things change. I want to know you're adaptable and can change and move accordingly.
I have so much I want to ask you, which takes me out of the topic that I wanted to stick with here, and that's getting really tough for me. So I am going to go out for a moment. How many, I shouldn't say how many, is it often that when you think about the companies that are the first time receiving investments, do you find that they understand truly how to work with an investor, meaning keeping them, at least that an investor understands what's going on, not hiding bad information, so you divulge the good, the bad, and the indifferent, How do you find working with with companies that is the first time they're receiving investments versus companies that may have had investors previously?
So most companies that seek angel investors have already gone through friends and family. So you've already tapped everybody you know, and they've given you what they're willing to risk. So this is their first professional contact, getting money from people they don't know. And quite frankly, most don't know how to approach it. They're unfamiliar with it. They understand it. They've seen it before, and they've seen other companies do it. But their initial contact very much sometimes simulates the contact they've had with their friends and family. And they're trying to convince them I'm a good person and you can trust me with your money kind of thing, where our focus is a little different. So you end up as an angel investor schooling them. Because you do sometimes see some great companies and some great potential, but we have to train them as
Right.
to how to pitch to us.
Right.
And that's a very difficult process because sometimes you don't want to spend that time
Right.
when you got so many others to look at.
I'm glad you know me now.
And that's why you exist, right?
Yeah, yeah.
So those are the kinds of focus areas that for new
Gotcha.
startup companies need to help them change their focus from friends and family
Right.
to professional looking for money and understanding that, yeah, your friends and family, yeah, they want to return, but they don't understand what a return is and how to
Right.
measure it and how to
Right.
time it and how to hold you accountable and those kinds of things. So now you're meeting people who are going to put
Right.
these kind of restraints on you, and it's usually the first round doesn't go as well.
Yeah, yeah. And I'm going to step back for a second. As a former investment banker, I recall we probably received an average of 25 business plans a month.
Right.
Now, this is when everything was still being mailed to you,
Right.
right? Not email. We probably got about 25 business plans a month. And it's so interesting now when I look at them, because back then, the first place I would actually look at is their marketing.
Right.
Because as we mentioned earlier in this segment, you have companies that are doing zero today telling you in 12 months they're going to be at 5 million, right?
Right.
So I would immediately go to their marketing to see if they had actions that would equal the possibility of
Right.
them getting to 5 million in 12 months.
Right.
How do you look at the business plan to assess whether it's truly pie in the sky projections versus projections that have some realistic value to them?
Right. And I'm glad you pointed that out because this is where your experience and my experience come in handy. Given that we've done those kinds of plans and
Right.
we've seen what types of actions actually lead to results.
Right.
And very much so, they're unrealistic, as you pointed out. So for me, it's how fast is that growth and what substantiates the growth? Not just, again, I'm going to
Right.
get 1% of a $2
Right.
trillion
Right.
industry or business. Sometimes that's relevant when you can see an entrepreneur say, this is how big the industry is, but this is my marketable subset of that.
Exactly.
And these are the ones I can reach, or these are the ones that's geographically appropriate. So it starts to show that they're being a little more realistic
Right.
than 1% of the $60 trillion
The world.
industry. Yeah, exactly.
Exactly.
So that becomes one indicator that they're looking at it realistically.
Okay.
Then when you look at their costs and their cost projections, are you reasonably staffing to accommodate that,
Right.
that marketing sale?
Right.
If one salesperson can bring in, $50,000 of revenue, and you tell them you're gonna do $1 million, well, you better do the multiplication and find out how many sales reps you're gonna
Exactly.
have. So some don't realistically show that in there. Some don't really show the industry stats on what's it cost to acquire a customer. If you can validate that to me to say
Right.
this is what it normally costs in this industry to acquire a customer, I can see you use realistic data to
Right.
build your plan, and therefore I can extrapolate out to that point as well and say, okay, that's
Right.
reasonable. I know it's going to change
Right.
anyway, but it's reasonable as a
Exactly.
start.
Yeah. Yeah.
So those are the kinds of things that you say, if I look at it and see that you worked backwards from that number and came to something that made sense,
Gotcha.
you're in better shape with me at that point.
Gotcha. Okay. And because there are also those entrepreneurs, just like you're saying, they're looking at the total market and making, and you don't even know how they're coming up with this number. I'm going to
Exactly.
capture 10% of the market. How do you know that? And where's that? So all those entrepreneurs, especially in the technology space, because that's generally where the numbers are much larger.
Right.
Technology and medical,
Yep.
right? But technology for the moment. While we understand the projections are they're just projections. And yes, looking at more of their detail. So now it has to understand, you look at these projections, you know that they're huge, they gave you a good enough story to understand they understand their market, and yes, the numbers may change later on, but what is it, how are you coming to that feeling that, but they have enough here for me to want to speak to them a little further.
Right, right.
Where is that coming from? How do you get to that place when you're looking at these plans?
You have a coin? I can flip. No, I'm just kidding.
Heads or tails, today, tomorrow?
This is where we go back to initial conversation about the differences between angel investors or investors in general.
Right.
Because I focused initially on companies that had sort of measurable returns. As I started doing this, I wanted to go with something that was a little less risky, some real estate with preferred returns and things like that. Then I moved into some of the consumer-based stuff. And then I finally focused in what I really enjoy.
Gotcha.
As an engineer, I like technology, and I like technology-focused companies, and I like disruptors.
Okay.
Disruptors are the ones that the highest risk, because
Absolutely.
you never know.
Yep.
And one example being a product that, for instance, today you walk in a Starbucks and yes, your Wi-Fi connects automatically and you got free Wi-Fi.
Right.
Or imagine in a few years, you'll walk in, your Wi-Fi connects, and whatever charging system you have on your phone connects.
Wow.
And your phone's charging while you're in Starbucks.
Right.
I'm investing in a product like that.
Gotcha.
But I don't know if they're going to get past any of the regulatory things, FCC and the health-related things, URL. There's a lot of risk going forward. And while they got it working on a demo level, will it work scaled up?
Right.
And can it get the cost down enough where it's effective?
Right.
But if it happens, it's disruptive.
Right. Right.
So now you're talking about, at a gut level, am I going to really take a chance on this? And how much of a chance, i.e. how much money am I willing to invest? That's where we're now looking at the differences between entrepreneurs and, and angel investors.
Right.
So in that room where I sit with the Dingman Angels and the other groups I'm in, maybe one or two of us out of 40 or 50
would go for that.
would go for something like that.
Right.
And I count on my technical background to say, I think that has potential, and it's not just a roll of the dice. There's something more.
But that's also where diversification comes in, right? Because
Absolutely.
you just spoke of that you have different buckets, and that happens to be your most speculative bucket.
Exactly, exactly. It works the same when you go to a financial consultant and they talk about a portfolio of various things and investments. It's the same idea, because the stats for angel investors, by the way, and this is why it's so tough for people to get money from angels, is that about 70% of the companies are going to fail.
Don't make it.
They won't make it. And another 20% may return your money.
Right. Right.
And another 10% may get you a good return.
Right.
And you might hit one out of the park.
And that's what you're relying on, that one to actually really help your money to have made money, because everything else might just get you to break even.
Exactly.
Yeah. How do you make that next step to actually start taking the company into the due diligence process?
Okay.
What does that look like for you as an angel, now that you've assessed some of the early pieces, got a sense of, if you can talk to how many meetings might you have? What do those meetings look like before you get to that step of saying, yeah, let me dig deeper and put this company through a due diligence process?
Okay. So depending on how I find them, and like I said, sometimes it's even through LinkedIn. So people contact me randomly through LinkedIn, or it could be any one of the online exchanges, AngelList, Gust. So depending on how I reach them, that'll determine how many levels I take. But let's say we start with just a quick one-paragraph introduction I saw somewhere. If I'm interested, I'll reach out to them, whatever means they provide, and I'll ask them for what's normally the investor would say. So that's a lot more detailed. It's usually about 10 slides or so, but it sort of elaborates on all the points that you were making. That's in your paragraph. So now I have more detail. And again, another point where I can say no, because now I'm filling in the blanks. Or again, assuming we want to go forward with the interest, then I want to meet them. So if they're local, we set up a meeting at that point. If they're not, we set up a conference call. Again, I let them pitch, so that it's not just a pitch deck. I want to hear them and hear the enthusiasm behind what they're saying, and see if I can understand if they have some expertise in the area. Beyond that, then it's discussion of terms. So
you'll meet with them prior to reviewing the business plan?
I would. Yep. So at this point, you're still selling me on the concept, because the business plan is a lot more detailed. And
spending more time in it.
Exactly. And a lot of times at that stage, a lot of people don't have business plans. So that's part of the risk I'm taking as well.
Gotcha.
And I have to extrapolate from the data I get from them to understand what their business plan might look like. So if they have it, I have a template at this point. So now here's all the things I send them the template. So they understand, just go down the list, and if there's something that doesn't apply, you got to tell me why and justify it. But it starts with all the basics like incorporation papers and documents. Are you legitimate? Are you legal? You have your business licenses and all those kinds of things. Because again, when you invest money, you don't want to find out 2 years later they don't even exist, and then there's some legal issues. But so those are the kinds of things that once I get past that, the initial paragraph, the pitch deck, and things like that. That's the legal, for me, part of the formal due diligence starts with that template.
Okay.
But I know we're not discussing that in this session.
Okay, no, but that's good to know because there aren't many investors, angel or otherwise, that will engage in the conversation if they haven't seen the business plan.
Right.
And or sometimes asking for the business plan is a way to say, I'm not interested.
Exactly, because I know you don't have one.
Exactly. Okay.
Right.
Okay. So now that they've provided you with the information and you still have a level of interest, that's closer to the point that you might then begin to engage them down the due diligence process?
Exactly.
Okay.
Exactly. And because the last step to that is if I'm convinced, still at this point, then it becomes that let's do a reality check on where you think the value of the company is and what it
Gotcha.
will be and those kinds of things. So we're starting to have a discussion about the terms of the agreement just to make sure we're in the same ballpark.
But I would imagine that's a tougher space with newbies in that because they have no clue what terms or you know.
But they have a great idea what the value of the company is.
Right, absolutely, it's $1 billion.
Exactly, you know, and right today it's worth that, right? So
really, you can't write me $1 million right now?
Exactly,
Yeah.
and so that becomes another, like I said, very complicated, very difficult conversation to give them a reality check on where it is.
Okay.
And as they go to other angel investors and finally get a fair idea what the market value is. Then it become more realistic at that point. But if you're the first one to see them, you know you're going to have that discussion and it's not going to go well.
Okay, that's interesting hearing it from that side. It is, I can think of one particular example of I had a conversation with this gentleman and he got very irritated with me because, you know, and I'm taking him down, I'm telling him what an investor wants to know, see, feel, or hear, right? And so his irritation to me was, well, I've been trying to raise capital for the past 7 years on it.
Wow.
That was my point. I'm like, okay, so if you've been doing it for 7 years, then apparently something is missing in that.
Right.
So either we want to sit down and talk about reality of you getting to the investment, or I'll speak to you again next year and you'll tell me the exact same thing all over again.
Exactly.
So I like hearing you when you say that the first angel that a lot of times the company speaks with is probably not going to wind up being an investor in that company.
Yeah, because it'll take a lot of training to get them oriented toward angel investing.
Right. So then I'm going to ask something that is really specifically for me. How much value do angels see in having some management process for them to weed through a lot of that information so that they are then getting those that sort of the tires have already been kicked and that type of thing? Is that a valuable service for an angel investor?
Absolutely. And to that extent, part of my role with the Digman Center Angels, as you remember, one of my titles is Entrepreneur in Residence.
Yes.
And my role there is to screen these entrepreneurs coming in before the group of angels see them.
Gotcha.
So we actually have a documented list of things that they need to do before they come to the screening.
Okay.
Then we schedule a screening. So myself and maybe 3 other angels, we walk through the process with them.
Gotcha. So
it has two purposes. First, we want to find out what they know and if it's valid for our team. And secondly, it's to educate them. So if we think they're ready to move on to the next part, we will tell them, here's the things you need to improve before you pitch before the rest of the angels. So this is a critical element that many of them miss. And most angel groups don't have that because this is part of the University of Maryland.
Right.
So they
have it set
they have the
up.
educational
Dingman
piece
Angels,
of it.
Now, the Dingman Angels, are they only reviewing business plans and potential investments from student entrepreneurs coming out of the school, or is it any company that submits?
It's any company that submits.
Great.
So it's online.
Okay.
There's a link to it, and any company can submit. And they encourage us as angels when we find things from other groups to bring into the group as well. But they do have a focus on their own MBA program and the engineering students and all the entrepreneurs there, which is great because you find a lot of diamonds in the rough in there as well.
Absolutely.
But that wouldn't sustain enough pipeline for the angels, so we incorporate.
So you open that.
Exactly.
And is there a criteria, meaning early stage startups, first round, second round, third round? Is there a criteria in that respect for which ones you guys will
There
look
is a
at?
criteria, but it's wide open. So
Okay.
it's really,
Okay.
generally speaking, it's those who are kind of exhausted to friends and family.
Gotcha.
But definitely not ready for VCs,
Not ready for
or
VCs,
even that
yeah.
first, that first
Gotcha.
round.
So it's still seed.
It's still seed, yeah,
Okay.
it's still seed. And
Okay.
generally companies in the $4 million and under valuation,
Okay.
if the company has realized that that's
Right.
where they are.
Right.
So if they come in and say, I'm
You
worth $1 billion.
You mean not the company that's really worth $500,000 right now, but their valuation is $4 million.
Exactly, exactly.
Okay.
So it's pretty wide in range and pretty wide in the types of businesses.
Gotcha.
So they're not just technology focused or software focused or ed tech or anything like that. It's pretty wide.
And so as we're rounding to the end of this, where do you see, how do you think of the brick and mortar companies? They're out here looking for capital also, and they may not be flying as high as some of the truly companies that are designed for high growth.
Right.
But they're good businesses, they're staid businesses, they need capital. Are those companies that are eligible in the angel private equity space?
Right.
What are your thoughts on those brick and mortar companies?
There is a space for it.
Okay.
And as we talked about in the beginning, the broad range of investors cover that as well. And even myself, like I said, as part of my portfolio, it's stable real estate.
Gotcha.
And these are malls in different areas and stuff like
Okay.
that where, again, we know the returns. They're predictable. They're managed by professionals.
Right.
So those type of businesses, while some traditionally can't go to banks and things like that, there are investors who are looking for, I'm a little more stable.
Right.
I want something a
Right.
little more predictable, and
Okay.
and my money has some kind of collateral backing it up,
Okay.
whether it's
Right.
inventory or
Right.
things like that. A lot of the companies I invest in have no collateral. So
Exactly.
if they close their
Exactly.
doors, they close their doors.
done. Yeah.
If they bought the phones, maybe all investors split the phones that they bought, but that's about it.
Gotcha.
So yeah, there's a wide range that include those kinds of businesses as well.
Okay. Hilton, I think this was fabulous. Thank you so much.
Thank you again for having me on. I appreciate it.
Absolutely.
Hope it helps someone.
And thank you guys for joining us here in Capital Academy. We hope that the information that you just heard directly from an angel investor resonates with you. Think about what an investor is looking for, because I know a lot of times when you want to talk about your businesses and raising capital, you're focused on what you need. In order for you to get what you need to consider what they need. So again, thank you for joining us today on Capital Academy. If you like what you heard, please make sure you're sharing it with others that it might resonate to. And until the next segment, we'll see you then.